The big question for both investors and traders that they always want to know is, what is the price going to be for whatever it is that we're investing in? In our case, it's cryptocurrency. And there are two approaches to find out answers to that, of what the price is going to be. And the first choice is fundamental analysis. Fundamental analysis is when you look at supply and demand for your investment, the quality of it, what the competitors are, what the market is, how much profit they might make, what kind of innovation is happening. And so one looks at all of that in fundamental analysis and then comes to a conclusion as to what that coin should be worth. So for an example, maybe I would look at Binance coin. And I would say that Binance is an entire ecosystem, much like Ethereum. And if Ethereum is currently worth about $2,500, then Binance, if it has a system that's not as developed as that, but is headed that direction, should maybe be worth, say, 2/3 of that. And 2/3 of $2,500 is, or rather 2/5 of that is $1,000. So I would say in the distant future, or not too distant future, Binance, with everything it's got going for it, should be worth somewhere around $1,000. So now I'm going to compare it to the current price. It's currently about $360. And I decide whether that's undervalued or overvalued. If I think it's undervalued, so I think it's going to go from 300 and some up toward 1,000, then I'm going to go ahead and buy it. And that's fundamental analysis. The other approach is called technical analysis. And in technical analysis, it's fascinating to me because technical analysis doesn't look at anything at all except for the price of the investment and the volume of buying and selling over time. That's all it looks at. And the reason it does that is because in technical analysis, it assumes that anything, any factors at all, supply, demand, innovation, competition, it assumes that all of that is already factored into the price by the investors. And as a result of which, technical analysis doesn't need to look at anything else. It only looks at the price and the volume of buying and selling over time. For example, let's say there's a rumor of a big buy coming up. Let's say when Michael Saylor started talking for MicroStrategy and promoting the fact that big corporations should buy Bitcoin. That was not necessarily a rumor of a big buy, but certainly a push for bigger companies to come in and buy. And that was factored into the price, according to technical analysis. Or take another example, Ripple. When Ripple was sued by the SEC, that was a legal action. And the price of that was factored into the price of Ripple. And another example of that would be when Ripple filed its own lawsuit against the SEC, suddenly the price of Ripple started to rebound. So that's how other actions, other than price or volume, comes into the way somebody in technical analysis looks at things by just looking at price and volume. Now, in addition to looking only at price and volume, there are two principles of technical analysis. The first is that prices move in trends. And that means that prices continue to move in the same direction until the trend changes. So we'll look at some trends in a moment, but by and large, it's saying that buying and selling in markets is very much similar to inertia, that an item that is in motion will continue in motion, an item that's at rest will continue at rest, unless some other force is applied to it. And the second factor that technical analysis relies on is the fact that history repeats itself. Now, the history in terms of technical analysis is in terms of pattern. It's in terms of price patterns on charts. And that certain patterns have established the fact that something that was going up is now going to come down, or something that was coming down is now going to turn around and go back up. But essentially, it believes the fact that if it sees a pattern that has continually signaled the fact that a trend is going to change, then it counts on that particular pattern. Now, obviously, technical analysis isn't 100% correct every single moment. In fact, it was interesting. There was a report a few weeks ago on hedge funds and how they invested. Guy at Coin Bureau did a great video on that. And one of the things that's in there that fascinated him and fascinated me as well is that there were 4 different particular investing styles. One style was called the quant, which is quantitative analysis, which is computers crunching numbers to see what kind of patterns there are, whether something's going to happen, and then the computer places buys or sells to match the pattern. And that particular style was the most popular of all of the hedge funds that answered that particular report. The second investing style was a combination of buying the investments long, meaning buying them and holding on to them, and doing some other sales of selling it short, a combination, so that it wasn't a play in only one direction. And the third method of investing was just buying and holding it long. And the fourth was a combination of all of those 3. And what was fascinating is the quant method was the most popular, with over 50% of the hedge funds using it. And the least popular was simply buying and holding long. But when the analysis was done of which of those investing styles was most profitable, it was the exact reverse. The quant investing style produced the least return, and the buying and holding produced the best return. So that's kind of interesting. And so we recognize that there are some things that happen and that the market tends to repeat itself, but there's absolutely no guarantees one way or the other. So now we're going to get into the chart basics. So in the top left over here, you see the interval of these little candlesticks. So this chart is set up for each candlestick being 1 day. And so each one of these is a day, and here's the timeline along the bottom. So you can see there's about 30 little candles here from December to January, and 30 year, et cetera. And then on this particular chart, one can choose to either see candles or one can choose to just see a line. And so let's look at the candles for a moment here. This is how the candlestick system works. The candlesticks have a big candle and then a possible wick on the top and a possible wick on the bottom. And that allows us to show 4 prices for each interval. So let's look at this. It shows the open price, which is the bottom of the thick part, which is the open price, if it's green. And then it shows the lowest price at the bottom of the wick. It shows the highest price at the top of the wick. And again, if green, it shows the closing price at the top of the fat candle. Now, the candle is green if it ended up closing higher than it opened. The candle is red if it opened higher and it closed lower, in which case these two, the opening price and closing price, are reversed. But even on the red candles, the wick that goes up to the top is the highest price it achieved that day. The wick that goes to the bottom is the lowest price that it achieved that day. And that's how they can get 4 different numbers on one line. I think it's rather clever, actually. And the other thing about the way candles work is that, as I told you, candle is green if it ends up closing higher than it opened. And it's red if it closes lower than it opened. So you can actually read this all the way straight across, and you can see that for these 4 days, it opened over here, and it went through this range and closed here. And then the next day, it opened up right at the same closing price, and it went up and down, but then it closed lower. And the next day was a green day, so it opened right at where that one closed, and it had a wide travel, but it closed up. And then the next day it closed even higher. So I guess I'm a little wrong on green as if it closes higher than the red. I guess green means it closed higher than it opened, not higher than the day before. So green opened here, closed there, and it closed higher than it went. And so you can see if there's greens in a row, that means the price is advancing each day. And if it's red, you would see it's closing each day. So that's the candlesticks. So that's what this choice is here. Now, over here on the right, you see the scale for the price. And on this particular graph, it shows what the price is in a box. The box is white on red if the price is currently, the last sale was down, and it shows white on green if the last sale was up from where it was before. And so throughout the day, as the price moves up and down, this thing will change as to where it is for the price, and it'll also change its color. We're going to get to the example in the next slide, so we'll hold that for a minute. And the last thing is the volume. And the volume is represented by a vertical line in the exact same line that the candle is for the price. And so you can look and see what the volume of sales was for a day. All right, well, so that takes care of what you can see on this particular type of chart. There's some other things you can see in terms of patterns and trends, but we'll get into that in a minute. I wanted to show you the example. Remember, the previous chart was by day. This chart is by 4 hours. So you can see that you can choose your interval, and depending on what interval you choose, this little bit right here, if I choose 4 hours instead of a day, becomes expanded. And this is important to know, because when you're looking for trends and you're looking for patterns, that will change depending on the interval that you're setting your graph to. So that's a worthwhile thing to know. And this happens to be the graph of BTC versus the dollar from this afternoon around 2 or 3. So it looks as though we're maintaining a nice sideways trend solidly between 30,000 and 40,000, which is interesting. And then we did the candlesticks. So now we're going to talk about support and resistance. When you listen to people talk about technical analysis, you'll hear them talk about there's a resistance line. And you can see this resistance line here in blue. And Bitcoin from December all the way through a little bit of January was trying to get up, hit the resistance, bounced back down, tried again, didn't actually break it until a little bit into February. So you had resistance holding it here. And once again, after it came down here, you'll notice that it banged up against resistance once again. And so technical analysts, people who are trading based on the technical charts, would say that as soon as it breaks this resistance, that means that it now has a different type of trend. And they would be interested in that. Some schools of technical analysis would say it not only has to break the resistance, but it has to go back, retest it again, and then continue on up. but this is a resistance line here. The other line we see on the chart is a support line. And the support line is the exact mirror of the resistance line. So the support line says that when Bitcoin is above it, when it heads down, it's going to have a tendency to bounce away from it because there's a lot of support here. And you can see the support line was good here, and it's held here. Even the huge drop on May 19th during the day didn't break that support line. And so that was valuable. If you look into this particular phenomena, you'll see that what happens is the resistance line is talked about as being where a lot of people bought it and then the price went down. And so they say to themselves, boy, if it ever goes back up again, I'm selling. And that you can see is kind of what happened in here. You saw some people who had bought probably here somewhere. And when it started to get back up to 40,000, they had set sell orders to get out of there so that they were no longer at a loss. They were going to give up any gain, but they just wanted to cover themselves. And that's kind of the phenomena that creates this resistance. What creates the support is pretty much the same thing. You've got people who simply are going to hold no matter what. They've bought low enough that they're not scared. And so they're going to hold on to it. Okay, so now let's look at some trends. So who would like to volunteer a trend or two that they see in this?
Well, over the length of the whole graph, it's trending up.
Okay, we certainly have an uptrend from the beginning to about here. Right, which was about the middle of April. And then from the middle of April coming down, I don't see that it's still an uptrend personally. But again, that's a really good point, Alan, because the question is, where do you start and where do you end the trends? But that's one big powerful uptrend, certainly. Any other trends? You see any other trends? Pam? You're muted, Pam.
What I see is these bounces are about $10,000, both on the upper level when it was going from 50 to 60 and back down and back up again. And then on the trend that is from about 40 to almost 30, those are about 10 also.
Yeah, good observation. Anybody else want to volunteer a trend they see? Okay, well, we certainly have a sideways trend going here. At least that's what I think.
Yeah.
I think that's a pretty good solid sideways trend. And one of the things that's interesting is if we go back and look at the support and resistance, we're right at the resistance. We're right at the top of this sideways trend because the price last time I looked before the meeting was 40,000 and change. So that's kind of interesting. So we're going to watch to see what happens there.
It's 40,119.
Beautiful. Okay. Now, in addition to all of that, there are certain common patterns that are used by technical chartists. And I haven't made an attempt to find the 17 different patterns because there's a lot of them. Some of them are a little tricky, but there are some that are fairly standard. And so I've just picked out 4 of the standard ones so you can see. And of the 4, I've picked out 2 that are trends indicating a top and it's going down, and that it's a bottom and going up. So the first pattern here is called a head and shoulders. Let's take this one over here. And the head and shoulders pattern goes up, forms a shoulder, comes down to the neck, goes up to the head, back down to the neck, back up to the head, and down again. This head and shoulders is generally thought to be a reversal. It was going up over here and it's now going down over there. So a head and shoulder top is something that people who are doing technical analysis watch for. Similarly, in the reverse, you can have an upside down head and shoulders, which is a bottom. So this is a head and shoulders bottom. And then we have triangles, sometimes called wedges. And so when you have a graph and it goes up and it comes down, it goes up, down, and it has a flat trend line on top, and it has a rising trend line on the bottom, that's considered to be a signal that right when it gets to the point of this triangle, it's now going to go up. And the reverse one is the descending pattern, has the graph going down, and then it bounces on a flat trend line, but the upper trend line goes down. And that's considered to be an indicator of the triangle for descending. There are lots more, but I'm going to let you guys Google them to go ahead and find out what they are. Because when you do it, what's valuable is to look at the patterns and then try and find them. They'll give you some examples on whatever page is explaining it, but go try and find them in some current graphs, especially those of coins that you own or are looking to buy or sell. And that's a really good way to do that.